Welcome back, everyone. We're on item 9 of the Avon Pension Fund Investment panel agenda, which is an update on the Brunel Pension Partnership, update on pooling. We've had a presentation from Liz Woodyard, our officer, and we've asked some questions in the private session. So now I would like to see a member of the committee move the recommendation that we note the progress made on the pooling of assets, and we note the project plan for the transition of assets remaining. Can I see a proposal? Thank you very much, Councillor Bruce Shern, proposer, and a seconder from?
Seconded. Thank
you very much, Pauline Gordon. Thank you very much. So that was item 9 on our agenda. Item 10 on the agenda is the review of investments performance for the periods ending 31st of December 2020, and our officer Nathan Rawlingson will introduce this item.
Thank you, Chair. Yeah, as I said, a couple of RI updates and then some brief operational updates before Steve and Hem will take you through the Mercer papers. So firstly, on the portfolios, you'll note from Appendix 4, the Brunel performance report, that all of the Brunel portfolios that we're invested in continue to track well below their respective indices for carbon intensity. Noting too that the absolute carbon metrics do vary from portfolio to portfolio. The sustainable equity portfolio, which we invested in during the quarter, for instance, has a kind of counterintuitively has a higher carbon intensity than the global active portfolio that we're in. And that's down to embedded or kind of supply chain emissions in some of the underlying companies. So the example we were given was Ørsted, who are one of the world's largest renewable energy companies. And they actually have a higher carbon output than you might expect due to the huge amounts of steel that they're sourcing to build their wind turbines. And it's these types of nuances that are starting to come out in the Brunel reporting now, and that are going to provide invaluable input into the 2022 stock take and the more general adoption of Paris-aligned portfolios. So I thought that was worth highlighting. On policy-related matters, officers are working to identify gaps in existing disclosures, which we can then bridge in order to comply with the new FRC Stewardship Code and TCFD for the current financial year. And then just briefly turning to the operational side then. So earlier this month, officers with Mercer scrutinised a number of counterparty banks that are going to be used to implement the fund's dynamic EPS as we approach expiry of the existing structure later this year. And Hemel is on hand to talk a bit more about that in closed session. In terms of rebalancing during the quarter, Liz already mentioned that we'd sold the residual position in Ruffer, our legacy DGF manager, and that was to bring the overall allocation to diversified return strategies in line with the 10% SAA, and the cash proceeds of that sale were placed in our liquidity strategy, which seeks to replicate the benchmark. So yes, I mean, I'm happy to take any questions on the covering report. Otherwise, I think Steve will take you through the performance before we move into exempt session. Thank you.
Thank you very much, Nathan. Anything on Nathan's bit before we have the Mercer presentation from Steve in open session? No, it doesn't look so in the chat. So thank you very much, Nathan. So over to you, Steve.
Okay, I'll share my screen then. So we'll start off with, I think we're due to start off on the performance report. So Q4 actually was a very good period for the fund from a return perspective, because pretty much all assets went up in value. And you can see the performance here for the 3 months and also the 12 months, which I think it's worth noting. But from a macroeconomic and market perspective, the key events in Q4 were the US election and Biden getting in over Trump. That generally pleased markets. One key reason for that is because the markets are assuming that in particular US-China trade tensions are going to be a lot less significant than they were before. The other major event is obviously we've managed to get through another sort of Brexit deadline, and whilst there could be issues resulting from that, the market has clearly priced in a lot of expectations. And towards the end of the quarter, we obviously got good news regarding vaccines, and that will sort of continue to this year. So in Q3, we saw very strong returns, and you can see the performance here. A lot of blue numbers here, which indicates outperformance. And clearly, so we've got most of the assets now managed in Brunel strategies. So going forward, we'll be able to sort of dive into the Brunel strategies in a bit more detail from Brunel themselves and based on the reporting that they give you. But clearly, some outstanding performance is to note are the Global High Alpha Fund, which outperformed by almost 14% last year. So that's an exceptional level of outperformance. And it's, so I think it's pleasing to sort of see sustainable equities, they outperformed, emerging markets outperformed in Q3, diversified returns, they got off to a good start in Q4, sorry. So overall, not much to sort of highlight really in terms of issues of concern performance-wise, because it was generally a very positive quarter.
Thank you very much, Steve. I have a question from John and then from Pauline.
Steve, just going back a slide, your slide 18. I just want on that risk-reward chart, particularly for property. How are you calculating the risk number? Because that looks low for property. Is that because it valuation cycle is lower than others? Therefore, you don't get the full volatility of it.
To be honest, I'd have to check on that one. Before I give you an answer in terms of the volatility calc. I'd like to say it's based on the actual valuation of your assets, which I think it is. And so, although there's been a lot of noise and a lot of talk, a lot of narrative about the problems of the property market, we haven't seen a huge drop in valuations in recent periods. So I think from memory, property values have been reasonably stable.
Yeah, it was contrast between infrastructure, which has a high risk, and property, which has the lowest of all, and it just felt wrong. So it'd be useful to see the calc.
Okay, we'll come back to you on that.
Thanks.
Thank you very much, John, for that question, Steve, for your response. Pauline.
Hi. Yeah, my question is around the global high alpha. Now, it outperformed last year massively, and I think we know broadly why, because I think they were really well positioned for COVID. So I just wondered if there was any feeling that perhaps post-COVID there might be a bit of a reversal there. So just feels to me like they run quite a lot of risk in that portfolio, and it's done well, so that's great. But is there a downside to that?
I think that's an answer for Brunel, really, Pauline, because we don't know the detail. We're not as close to the detail as they are regarding the portfolio. I mean, a couple of observations though, based on what we do know. Their allocation to Baillie Gifford long-term global growth was a huge contribution to the performance.
Yeah, that's what I'm thinking about.
Yeah, for those that don't know, I mean, Baillie Gifford pretty much outperformed the benchmark by almost 100% last year. A lot of their stocks more than doubled in value because they had a lot of stocks that just performed very well in light of the K-shaped recovery that was related to COVID. During that period, though, Pauline, they would have had some managers. So there's one manager called Harris, has quite a strong value bias, and that would have struggled. Value as a style that has actually done pretty well year to date, and Baillie Gifford have probably struggled. So hopefully the kind of balance of styles that Brunel have got in the portfolio should lead to some more consistent performance. But yeah, Baillie Gifford's performance was exceptional last year. We wouldn't expect that from any manager to be repeated on a consistent basis.
Can I just add that the portfolio does have a quality and a growth bias as well overall, which did do really well last year. So, and I think over the year, 4 of the 5 managers, as Steve said, it was only Harris that underperformed, but obviously they are now performing a bit better. So, but we always at Client Group, we do always question how they're managing the risk of Baillie Gifford, because they are a very high conviction manager in the that's the way they run their portfolios, and the way that they mitigate the risk mainly is that they have a much smaller allocation to Baillie Gifford than they would have if they had a slightly lower conviction portfolio. But Baillie Gifford as well have been very active in trading, taking profits on some of its very good performing stocks. So it's not that they just sit there and run with the stocks, but they do get into new ideas and new themes very early on. I think that's the nature of their investment philosophy.
So I thought I'd press the button. Thank you very much for that. I have a question, Steve, with regard to the currency market. And obviously the sterling has strengthened over the quarter against the dollar, euro and the yen. But why, given what you said earlier with regard to the election results in North America, in America, has the sterling strengthened far more against the dollar than against the euro?
I mean, it's difficult to be precise about the relativity of the move, but generally speaking, sterling has strengthened because of the market's perception of the impact on the sort of vaccine rollout.
Okay.
Clearly there's a difference between what's happening between UK, Europe and US at the moment, but yeah, that's the sort of principal reason, because the market is expecting that should lead to a faster than otherwise expected improvement in the UK economy.
Okay, thank you.
Steve, is there nothing to do with expectations of interest rates or bond yields, though, not moving the markets, the currency markets?
I mean, the market's not pricing in or expecting any movements, if at all, really, Liz, from a UK interest rate expectation. So I think, I mean, you never really know exactly what the key driver is, but our feeling is it's the impact of the vaccine from a sterling perspective. That might actually be a good segue just to give an update on our sort of forward-looking market views, which was just going to sort of cover on this slide. So what we do, we give our sort of views on the prospects for the performance outlook for the major asset classes on a 1 to 3 year basis. And notwithstanding the fact that equities in the last 9 months of last year, so post-March, performed very strongly, and also growth fixed income areas such as high yield credit, which is relevant to you in multi-asset credit, we're still actually quite constructive on return-seeking assets. And that is because of the combined impact of vaccine rollouts, continued support from central banks and governments, and an expectation that bond yields remain low. But I think it is noteworthy to just be aware of what's been happening in markets recently. Because I think it does have an impact on you in terms of the next section when we talk about risk management. But in the last week or so, there has been quite a steep rise in bond yields. And the connection there is that if bond yields rise too quickly, too high, that could lead to a sell-off in equity markets. And we've seen some signs of that. And so notwithstanding our overall constructive view on these markets, there's always reasons to be sort of mindful for what could lead to some turbulence, and we appear to be in one of those periods right now. But the reason why bond yields have been sort of rising, so bonds have been selling off, is because of concerns regarding increasing inflation expectations as a result of stimulus. So we'll have to be sort of mindful of that and watch out. But don't forget, you've got the equity protection in place. So if things get extremely bad, that should give you some cushioning versus the levels of when you implemented. But we did maximize the level of inflation protection that we could have in the portfolio. And we've seen UK inflation expectations rise this quarter. So far that increased move would have been beneficial for the fund. So if there's any questions, if there's any more questions on this section, it'd be good to take now before we go on to the risk management section.
Doesn't look like there are at this stage.
Okay, and then, can I just check, is that in a public or private session?
We're still in public.
Okay.
We're still in public, and I think if your risk management is usually in private. Right.
Okay. Sorry, a bit slow then. So therefore, sorry about that. Can I ask for a proposer and seconder to the motion that the panel, having been satisfied that the proposed public interest would be better served by not disclosing relevant information, that in accordance with the provisions of section 100A4 of the Local Government Act 1972, that the public should be excluded from the meeting for this item of business because the likely disclosure of exempt information as defined in paragraph 3 of part 1 of Schedule 12A of the Local Government Act as amended.
So moved, Chair.
Thank you very much, Councillor Bishern. And a seconder?
Seconded.
Thank you, Shirley Marsh.